the 5-year Medicaid trap that ruins 99% of senior families. You think you're helping your kids by gifting a few thousand here and there. Then a health crisis hits, you apply for nursing home Medicaid, and boom, the last 5 years of your finances are dissected, and those small gifts block coverage for months. Families lose tens of thousands waiting. Most never see it coming. Here's the fix. I'll show you how the 5-year lookback really works, what Medicaid actually pays for, the penalty formula shortcut, which assets are safe, and the legal moves that don't trigger trouble. We'll start simple and get practical fast. First step today, know exactly what Medicaid covers and what it doesn't so you can stop the bleeding now. What Medicaid actually covers versus what people assume. Most people think Medicare will handle long-term care because it's medical, but that's where plans fall apart. Medicare is great for hospitals, doctors, and short rehab after a qualifying hospital stay. It does not pay for custodial long-term care, help with bathing, dressing, eating, toileting, beyond brief, limited rehab windows. That everyday help is what drains savings. And that's where Medicaid steps in. Miss this distinction, and you risk burning through assets before you even realize there was another path. Medicaid is the program that pays for long-term custodial care when you meet strict financial and medical rules. It can cover nursing home care in every state. Depending on your state, it may also fund assisted living or home and community-based services through waiver programs, but access caps and wait lists vary. That variation is the first thing most people miss. States run Medicaid under federal guidelines, so the core ideas are similar, but the details, income thresholds, asset limits, exemptions, and paperwork are state-specific. Let's break it down by setting. Nursing homes. Medicaid routinely covers long-term custodial care when you're medically eligible and meet financial criteria. Assisted living. Some states have waivers that help with services, not room and board, and slots can be limited. Home and community-based services. Waivers can fund in-home aids, adult day health, and respite, but approval can be slower and availability depends on budgets and wait lists. Translation. Nursing home coverage is the most reliable lane. Home and assisted living coverage exists, but you can't assume it's guaranteed or immediate. If your plan depends on waivers, build a plan B now so a wait list doesn't become a 5-figure surprise. Now, the financial side. Medicaid looks at income and assets. Income tests focus on your monthly inflow, Social Security, pensions, annuities. In nursing home Medicaid, most of your income typically goes to the facility as a patient responsibility with a small personal needs allowance. If you're married, your spouse at home may be allowed to keep enough income to meet a minimum monthly needs standard, but again, the exact numbers are set by your state. Assets are split into exempt and countable. Exempt assets don't hurt eligibility while you're alive, like one primary residence under certain equity limits, one car, personal belongings, and sometimes certain retirement accounts depending on the state. Countable assets include cash, checking and savings, investments, a second property, non-exempt annuities, and in some states the cash value in life insurance. We're going to go deep on exempt versus countable in a minute, but here's the headline. Medicaid isn't trying to make you destitute, but it does require that non-exempt resources get spent down before it pays for long-term care. Why does this matter? Because private pay rates for nursing homes often run $8,000 to $12,000 a month, sometimes more in high-cost areas. If you're not eligible yet, you pay that bill every month until you are. That can burn through a modest nest egg in under a year. I've seen families sell investments at a loss or cash out retirement accounts with taxes and penalties simply because they waited too long to understand the rules. Planning while you're healthy prevents panic when a health event hits, and it's the difference between control and crisis. Here's the piece that trips people. Even if you meet the asset and income limits on paper, Medicaid still combs through your last 5 years of financial activity to see if you moved money out of your name for less than fair market value. Gifts to kids, church tithes beyond a pattern, a deal selling the car to a nephew for cheap. Those are the transfers that can cause a penalty. We'll cover the look back and the penalty math right after this, but I want you to anchor one core idea now. Medicaid can pay for long-term custodial care when Medicare won't, but you have to qualify medically, financially, and cleanly from a transfer standpoint. If you plan early, you can convert some countable assets into exempt items, document legitimate payments, and avoid landmines. If you wait until a hospital discharge planner says, you need a nursing home tomorrow, you're stuck private paying while you clean up 5 years of transactions. Quick when you can do today. Write down where care would likely happen in your state, nursing home, assisted living waiver, or home and community-based services, and call 2 facilities or agencies to ask if they accept Medicaid and how their admissions work. You'll learn fast whether your area leans on waivers with wait lists or can convert a private pay bed to Medicaid later. That one call changes how you plan cash flow, spend down timing and documentation, and it gives you names, dates, and real answers to anchor your decisions. Now that you're clear on what Medicaid actually covers and what it doesn't, let's dig into the 5-year look back. This is the trap that quietly blocks coverage even when you meet every other rule. The 5-year look back rule, how it really works. The look back is simple on paper and brutal in practice. When you apply for long-term care Medicaid, the state reviews the last 60 months of your financial life. They're not judging intentions. They're scanning for transfers where you gave away assets or sold something for less than fair market value. If they find them, they calculate a penalty period where Medicaid won't pay, even if you're otherwise eligible. That's months of bills with no safety net unless you've prepared. What counts as less than fair market value? Gifts of any size, birthday and holiday gifts, college help for a grandchild, tithes and charitable donations if they're outside a long, consistent history, selling a car for a family price without proof of actual value, forgiving a personal loan to your son, adding a child to your bank account, and they use your funds, moving money to a trust you can still benefit from. If the value you received back isn't equal, it's a problem. Here's the thing most people miss. The review is document-driven. Caseworkers aren't guessing. They look at bank statements, brokerage statements, retirement account withdrawals, property records, annuities, life insurance cash values, and trust documents. They notice cash withdrawals, round number transfers, Zelle and Venmo payments, checks to family, and deposits that bounce between accounts. If something looks unusual, they ask for proof of what it paid for and why. Let me break down how they decide. Step 1. Identify transfers in the last 60 months that appear below fair market value. Step 2. Total the amount of those disqualifying transfers. Step 3. Apply the penalty formula for your state. We'll do the math in the next section, but the key is this. The calculator doesn't care that the gift was small or for the grandkids. It only sees the date and the dollar amount. Cold math beats warm intentions every time. Gifts to anyone count, not just to your children. That includes church charities and even well-meaning help to a neighbor. Repeated small gifts are especially sneaky. On their own, $100 here, $200 there feels harmless. Over 3 years, that can add up to thousands. And once you stack them, the penalty stretches across months where a nursing home bill is due every 30 days. Audit scope is wide. Expect to provide 5 years of bank statements for every account with your name on it, including joint accounts. If your name is on an account with your child, Medicaid treats those funds as yours unless you can prove otherwise with deposits, ownership documentation, and a clear source of funds. Property? They'll want deeds, closing statements, and appraisals if you sold within the lookback. Annuities and life insurance? They'll read contracts to see if they're countable and if any changes were made. Intent doesn't matter. You might say, I didn't know, or we did that to help family. The rules don't evaluate good faith. They evaluate transactions. If you sold a car worth $8,000 to a niece for $1,000 and can't document an $8,000 value drop due to damage, Medicaid will count $7,000 as a transfer for less than fair market value. If you wrote $500 checks to each grandchild every Christmas, those add up. Micro-story. I worked with a daughter whose mom gave $200 a month to each of 2 grandkids for college savings. It felt responsible. Over 15 months, that was $6,000. Add 3 larger birthday checks and a below-market furniture sale for $1,000, and the total hit $8,500. In their state, that translated to several months of penalty. The facility bill was due regardless. What fixed it wasn't arguing intent. It was building documentation to show which transfers were reimbursed or were purchases at fair value, then reducing the total exposure. Now here's where most people mess up. They try to fix the lookback by making new transfers. Don't. Every new disqualifying transfer resets the 5-year clock on that transaction. So inside the lookback, stop gifting. Collect receipts. Build explanations. You're in damage control, not creative. Planning. Think audit mode. Freeze, document, and stabilize. Another nuance. Cash withdrawals. Medicaid hates them because they're hard to track. If you pull out $3,000 cash and can't show receipts that tie to legitimate purchases for fair value, the default assumption leans toward a transfer. Same with ATM withdrawals that don't match a pattern. If you truly use cash, start saving receipts and logging dates, vendors, and purposes. Finally, understand that not every move is disqualifying. Paying fair market value for care, home repairs, medical and dental treatment, durable medical equipment, and prepaid funeral arrangements can be legitimate spend downs when properly documented. The difference between a penalty and a clean transaction is paperwork. If you remember nothing else from this section, the look back is mechanical, the evidence matters more than the story, and you need a clean 5-year paper trail. Once they flag a transfer, the next step is the penalty math. That's your hidden bill. I'll show you the exact formula when the penalty starts and a quick way to estimate your state's divisor so you can see your risk in minutes. The penalty period formula, your hidden bill. Here's the simple math the state uses and why it hurts. Take the total value of all disqualifying transfers they found in the lookback. Divide that by your state's penalty divisor, which is just the average monthly private pay nursing home cost the state publishes for this calculation. The result equals the number of months Medicaid won't pay. No appeals to emotion, no rounding in your favor. It's arithmetic, predictable, unforgiving, and avoidable if you act now. Let me show you how to estimate this fast. First, total your exposure. List every transfer for less than fair market value they could flag. That might be $10,000 in gifts, a $7,000 underpriced car sale, and $3,000 in undocumented cash withdrawals. Your working number is $20,000. Second, find your state's divisor. You can usually Google state name Medicaid penalty divisor nursing home, or call a local elder law office or Medicaid eligibility worker and ask for the current figure. It often ranges from about $6,000 to $12,000, depending on state costs. Now plug it in. If your state's divisor is $8,000, then $20,000 divided by $8,000 equals 2.5. That's a 2.5-month penalty. During those months, Medicaid won't pay, even if you're otherwise eligible. The nursing home still wants its money, so either you private pay, family covers it, or the facility goes unpaid, none of which are good outcomes. Here's the trap most people don't see. The penalty doesn't start the day you made the gift. It starts when you're both medically eligible for nursing home level of care, financially eligible under the limits, and you've applied for Medicaid. That means a gift today doesn't run out the clock unless you stay healthy and out of care for 5 years. If care is needed in year 3, the penalty is waiting for you right when the bills spike. Stacked gifts multiply the problem. 10 $1,000 gifts spread across birthdays aren't harmless when they sit inside the Lookback and add up. The formula doesn't care that they were special occasions. It adds them to the total and divides once. So the risk compounds across years if you're casually gifting or moving money without documentation. A quick one you can do in under an hour. Audit your last 60 months and make a 2-column list. Column 1, routine documented expenses, rent, utilities, insurance, groceries, medical bills, taxes. Column 2, non-routine transfers, large gifts, cash withdrawals, transfers to family, below market sales. You're building the raw material for a penalty estimate and, more importantly, a documentation plan to reclassify what you can. This single exercise turns fear into a checklist. Now, how do you get your state's divisor if you can't find it online? Call 2 nursing homes' business offices and ask what figure they use for Medicaid penalty calculations this year. They deal with this daily and can tell you the number or point you to the right state bulletin. Once you've got it, you can run a rough calculation and see if you're risking weeks or months. Common mistakes to avoid here. First, trying to offset an old gift with a new one. A new transfer doesn't erase the old. It adds to the total and starts its own 5-year clock. Second, assuming tiny gifts won't be found. 5 years of statements make patterns obvious. Third, delaying the application because you're afraid of the penalty. The penalty clock only starts when you apply and meet the other criteria. Waiting can trap you in indefinite private pay. There's a legitimate way to reduce the penalty that most people miss, proving fair market value. If you sold that car for $1,000 but can document mechanical issues and an appraisal showing a $1,200 value, suddenly the gift shrinks or disappears. If you paid family for care at fair market rates with a written contract and timesheets, that's not a gift, it's a legitimate expense. The difference is paperwork. If you remember nothing else, the penalty formula is total disqualifying transfers divided by the state's divisor, and the penalty starts only when you're otherwise eligible and have applied. Use that to estimate your exposure and build a plan. Next, we'll cut that risk by separating what you can keep from what counts. Exempt versus countable assets. This is where you protect the essentials without triggering penalties. Exempt versus countable assets, what you can keep. Let's make this simple. Some things you can keep without hurting eligibility, some things count against you, and a few sit in a gray zone that depends on your state. Knowing which is which lets you spend down cleanly and avoid penalties. Start with the big one, your primary residence. In many states, your home is exempt while you're alive if your equity is under a state-set cap and you express an intent to return, even if that's not realistic. If there's a spouse or certain dependent relatives living there, the home remains exempt during your life. Don't confuse exempt now with safe forever, though. Estate recovery can pursue the home after death if it passes through probate, and no protected survivor blocks recovery. We'll hit recovery later. For now, know the home can be exempt during eligibility. Plan both entry and exit. Next, one vehicle is typically exempt, regardless of value if used for transportation. Personal belongings and household goods are exempt. Furniture, clothing, basic jewelry. Burial spaces for you and immediate family are exempt. Prepaid, irrevocable funeral and burial contracts are usually fine when documented properly. These are clean spend-down targets because they meet real needs and don't trigger penalties. Retirement accounts are where state rules diverge. In some states, An IRA or 401k in payout status with required distributions can be treated differently than one you can liquidate freely. The account value might be countable, or only the monthly distribution may count as income. This is a check your state item. Same with life insurance. A small face value policy may be exempt, but policies with cash value often become countable above a small threshold. Ask specifically how your state treats cash value. Now the countable side. Cash, checking, savings, non-retirement brokerage accounts, CDs, second properties, vacation homes, non-exempt annuities, and multiple vehicles beyond the one allowed. If your name is on an account, Medicaid will presume the funds are yours unless you can show deposits came from the other owner and you didn't use the money. That's why joint accounts with adult children cause trouble. Commingled funds are hard to untangle, and during the lookback, they'll be scrutinized. Community spouse protections matter if you're married. The spouse at home can keep a certain amount of the couple's countable assets, the community spouse resource allowance, and enough monthly income to reach the minimum monthly maintenance needs allowance. The numbers are state-specific and adjust periodically. The key idea: you don't have to spend everything down to zero if there's a healthy spouse at home. Structuring assets to maximize those allowances is one of the most impactful planning moves. Here's the thing most people miss. You can often convert small countable assets into exempt items quickly and legitimately. Examples: pay off medical and dental bills, buy an irrevocable prepaid funeral plan, replace unsafe flooring, fix the roof, install grab bars, and a ramp. Home modifications that support care are legitimate. Purchase a reliable primary vehicle if you need one. Upgrade a worn-out mattress or a lift chair. These are not gifts, they're fair value purchases with receipts. Practical move today. Categorize everything you own into 3 buckets: exempt, countable, risky, exempt. Home, subject to limits. 1 car, personal items, irrevocable burial, possibly retirement accounts depending on state and payout status. Countable, liquid cash, investments, second properties, extra vehicles, cash value life insurance above small limits, most non-compliant annuities. Risky, joint accounts with kids, informal loans to family, assets titled in ways that blur ownership, trusts you can still control. Risky doesn't mean illegal. It means likely to trigger questions or penalties without expert cleanup, and the fix is usually paperwork and timing, not magic. Let me show you exactly how to use this. If you're single and over the asset limit by, say, $12,000, don't gift it. That would create a penalty. Instead, spend down on exempt needs. Prepay funeral/burial with an irrevocable contract. Resolve dental work, pay for durable medical equipment, and handle home safety improvements. Keep every invoice, receipt, and proof of payment. You drop under the limit without triggering the lookback. If you're married, coordinate with the community. Spouse allowances. Move countable assets to the spouse as permitted. Evaluate a Medicaid-compliant annuity where appropriate in crisis states that allow it, and ensure the spouse retains enough income and resources inside the rules. Documentation is everything. Statements showing transfers between spouses, annuity contracts, and verification letters. Common mistake: selling a house or car to family below market without an appraisal. That turns part of the value into a gift. If you need to sell, get a written valuation or market comps, list it if possible, and show the sale was at fair value. Another mistake: cashing out life insurance with cash value on the eve of application, then gifting the proceeds. That stacks a countable asset and a transfer penalty. Better, evaluate whether to surrender and spend down on exempt items or keep if under the exemption. Quick win: pull policy summaries for any life insurance and annuities, note cash values and surrender penalties, and ask your state Medicaid office or an elder law attorney how those instruments are treated locally. You'll avoid surprises and can line up clean spend downs. If you remember nothing else from this section, exempt means usable without disqualifying you now, countable must be reduced or restructured, and risky needs cleanup and documentation. Convert countable to exempt with fair value purchases, never with gifts. Keep receipts. Protect the community spouse's allowances. And always think 2 steps ahead about estate recovery on the home. Timing and paperwork turn the same dollars from a problem into a solution and into approval instead of penalties. Timing strategies when planning still works. Timing decides what tools you can use without blowing up eligibility. Think of it in 2 lanes. Outside the 5-year window, you can move proactively. Inside the 5-year window, you switch to cleanup and documentation. The mistake is trying to use outside the window moves when you're already inside. That's how penalties happen. The calendar is either your shield or your trap. Let's start with early planning, more than 5 years before you might need care. This is where you can make documented, fair transfers and let the clock run. If you want to help kids or reposition assets, do it cleanly with receipts and market values. If a trust is part of your plan, it needs to be the right kind, typically an irrevocable trust you don't control and don't benefit from. So transfers to it are treated as completed gifts. Then you wait out the full 60 months. The clock wipes those transfers off the look back, and you keep flexibility later. Now, the reality most families face: crisis or near crisis planning inside 5 years. This is not the time for gifting. Every disqualifying transfer you make now creates a penalty and starts a new 5-year clock on that transaction. So pause all gifts. Your focus shifts to damage control. Identify past transfers, document fair value. Where possible, reclassify legitimate expenses and convert remaining countable assets into permitted exempt items with airtight paperwork. Here's the part that separates beginners from pros. The clock resets with each disqualifying transfer. If you gifted $5,000 4 years ago and then gift $2,000 today, the earlier gift is only 1 year away from aging out, but the new gift traps you for another 5 years on that piece. That's why stopping gifts immediately is powerful. You freeze the damage and let older transfers slide off the look back as time passes. Waiting for a formal diagnosis before planning is expensive. Families often tell me, "We'll handle this if mom gets worse." But long-term care needs often jump after a fall, stroke, or hospitalization. If you start at that moment, you're private paying $8,000 to $12,000 a month while you untangle 5 years of records. Acting before decline means you can set up care contracts, prepay burial, fix the house for safety, and if you're outside 5 years, complete transfers that won't be penalized later. Once you nail that, everything else clicks. Inside 5 years, you work the levers that don't trigger penalties. Spend downs on fair value needs. Personal care agreements that pay family at market rates with timesheets. Spousal strategies that shift assets within the marriage under allowed rules. Medicaid compliant annuities for the community spouse in states that allow them. None of these create disqualifying transfers when they're structured correctly and documented. Your advantage is speed plus receipts. Let me give you a quick timing decision tree. If you're outside 5 years, consider whether any gifts or trust transfers make sense, but only if you can afford to lose control of those assets and still cover 5 years of care if needed. Start the clock now, not after symptoms show up. If you're inside 5 years, no gifts, no bargain sales, no last-minute title changes. Build your Medicaid binder, categorize assets, and plan spend downs you can execute in weeks, not months. Micro story: 2 sisters called me about their mom. Family 8 started planning at month 61. They'd moved modest assets into an irrevocable trust, documented every move, and kept mom spending clean. When a stroke hit at month 63, there were 0 look-back penalties. They spent down a small cash cushion on medical needs, filed a tight application, and Medicaid approved on the first pass. Family B started at month 47. They had 2 years of sporadic gifts and a house sale to a son at a discount. The penalty stretched several months, and they private paid while we scrubbed records, got an appraisal to fix the house valuation, and set up a care contract to legitimize payments to a daughter. Same love for mom, different timing, 6 figures of difference. Before we continue, you need to understand the tempo. Timing isn't just calendar math, it's paperwork velocity. The sooner you stop risky activity and start clean documentation, the faster you shorten private pay time. If the application is in sight, you want your last 60 months organized, explanations drafted, and purchases completed with receipts. Momentum cuts costs. Action steps you can do this week. First, freeze gifting. Second, map your timeline. Are you outside or inside 5 years on any past transfers? Third, list time-sensitive fixes. Appraisals for any family sales, written care agreements if family is helping, and quotes for exempt spend-down items like burial and home safety upgrades. Finally, schedule a consult with a local elder law attorney to confirm state-specific rules, especially for retirement accounts and spousal. Options. If you remember nothing else, outside 5 years, you can shift assets with patience. Inside 5 years, you clean up, you document, and you convert Countable to Exempt without creating new landmines. The clock is either your ally or your enemy, depending on when you start. Legal tools that don't break the rules. Now let's use tools that work inside the rules so you can protect cash flow without triggering penalties. Think of these as clean levers. They convert countable assets into allowed forms, pay for real needs at fair value, or shift resources between spouses under specific rules. Done right, they're mechanical, documented, and penalty-free. Start with Medicaid-compliant annuities for the community spouse. In crisis cases where one spouse needs nursing home care and you're over the resource limit, some states allow the community spouse to turn excess countable assets into an immediate, irrevocable annuity. The payout goes to the community spouse, not the applicant. Key requirements. The annuity must be immediate, non-assignable, actuarially sound based on life expectancy. Name the state as remainder beneficiary up to benefits paid, and pay out in level payments with no balloon. When those boxes are checked, the asset turns into an income stream for the healthy spouse and is no longer countable for the applicant. This is timing sensitive and state specific, so coordinate with an experienced local attorney and get the contract language exactly right. One wrong clause can tank eligibility. Next, spousal transfers. Within a marriage, you're generally allowed to transfer assets between spouses without creating a penalty. This is critical in crisis planning. You can move countable assets to the community spouse's name, then use the community spouse resource allowance to protect a chunk of those assets. In some states, spousal refusal exists. The community spouse can refuse to support the institutionalized spouse, forcing the state to determine eligibility based on the applicant's resources alone, while reserving the right to seek contribution later. It's a niche strategy, very state dependent, and comes with potential legal follow-up from the state. So only use it with counsel who handles it regularly. Personal care contracts are the game changer most families overlook. If a child is providing care, pay them at fair market rates under a written agreement signed before services are rendered. Spell out duties, hours, rate, and start date. Keep timesheets and proof of payments. This converts what would look like gifts to kids into legitimate documented expenses for care. 2 traps to avoid. Don't do lump sum back pay without clean logs. It's often treated as a gift. And don't set a rate above local market. If the area pays $22 an hour for home care, don't write $40. Paper first, payment second. Spend downs are your cleanest tool. You're allowed to spend countable assets on real needs at fair value: medical and dental care, vision and hearing, durable medical equipment like wheelchairs or lift chairs, home safety modifications, grab bars, ramps, wider doorways, necessary repairs, and an upgrade or replacement of the one exempt vehicle. Prepay for an irrevocable funeral and burial within state limits, and keep the contract. Pay off legitimate debts. The key is receipts and invoices that match bank statement payments. If it doesn't look like a normal household or medical expense, expect questions, so prepare explanations in writing. Funeral and burial pre-need plans are simple and effective. Use an irrevocable contract with a reputable provider, itemize what's covered, and keep the policy declaration. Burial spaces for you and immediate family are typically exempt. This not only reduces countable assets cleanly, but also takes pressure off family later. Home modifications deserve special mention. If returning home is part of the plan or the community spouse still lives there, spending on safety and accessibility is both practical and compliant. Document contractor estimates, permits if required, paid invoices, and completion photos. Medicaid reviews love seeing necessary improvements tied to care needs. When does each tool fit? If you're single and inside 5 years, lean on spend downs, prepaid burial, medical work you've been postponing. And if family is helping, a properly executed care contract going forward. If you're married, coordinate spousal transfers to reach the Community Spouse Resource Allowance. Evaluate a Medicaid-compliant annuity if your state allows it in crisis, and ensure the community spouse retains enough income under the minimum monthly needs rules. If you're outside 5 years and considering an irrevocable trust, understand you must give up control and benefit. Otherwise, it won't remove assets from being countable or from estate recovery in some states. Always start that clock, only if you can safely cover 5 years of potential care. Common mistakes to avoid with these tools. Buying an annuity that isn't Medicaid compliant. Wrong terms turn it into a countable asset. Writing a vague caregiver agreement without timesheets looks like gifting. Prepaying a funeral with a revocable plan, still countable. Paying relatives for home repairs without invoices. No paper trail equals gift. And mixing spousal funds into joint accounts right before application without clear statements confuses ownership and slows approval. If it would confuse a bookkeeper, it will confuse Medicaid. Clarify it on paper. If you remember nothing else here, legal tools work when they're boring and documented. Use compliant annuities only for the community spouse. Transfer within marriage under the rules. Pay family with signed contracts and timesheets. Spend down on real needs with receipts. And make burial plans irrevocable and itemized. The right tool at the right time turns a penalty risk into a clean approval path. The landmines, common mistakes that trigger penalties. Now here's where most people mess up. Innocent moves that look fine in normal life, but explode under Medicaid review. First, gifting to kids to keep it safe, inside 5 years. You move 10 grand to a daughter's account for emergencies. On paper, that's a transfer for less than fair market value. There's no service rendered, no product bought, no contract. It's a gift, and it stacks into the penalty math. If you want to help a caregiver child, use a written personal care agreement going forward. Rate duties, timesheets, payments by check or transfer with memo lines. Retroactive lump sums are almost always treated as gifts. Second, selling a house or car to family below market without an appraisal. You think you're being practical? We'll give our son a deal. Medicaid sees the difference between market value and the sale price as a gift. Fix it before application. Get a professional appraisal or comparable sales. Show a listing history if possible, and sell at or near the documented value. If the property needed work, gather contractor estimates and photos to justify a lower price. No paper trail, no fair value. Third, cash withdrawals with no receipts. Pulling out $300 here, $800 there. Then tossing receipts is a fast road to trouble. Caseworkers don't assume the best. They need evidence. If you've already withdrawn cash, reconstruct what you can, ask vendors for duplicate receipts, gather credit card statements for adjacent purchases, and write clear explanations. Going forward, Pay by check or card for big items. If you must use cash, keep itemized receipts and write the purpose on them the same day. Fourth, joint accounts with adult children and commingled funds. My name's just on there to help mom. Medicaid presumes funds with the applicant's name are theirs unless proven otherwise. If the child deposited their own paycheck into the joint account, you need deposit records showing the source and that the applicant didn't use those funds. Better structure. The child has view-only access or a durable power of attorney, while funds remain solely titled to the parent until you can cleanly separate. Fifth, moving money between accounts right before applying. Shuffling balances across banks or between owners without a clear reason and documentation triggers extra scrutiny and delays. The fix is simple. Keep a transaction log explaining any large or unusual movement, date, amount, purpose, destination account, and attach supporting statements. If you're consolidating to simplify, say so and show both statements. Sixth, informal loans to family. You write a $5,000 check to a grandson as a loan with no promissory note and no repayments. Medicaid treats it as a gift. If it truly was a loan, you need a signed dated promissory note at the time of the loan, market rate interest, a set repayment schedule, and proof of payments. No retroactive paperwork. Seventh, reimbursing family caregivers without a pre-existing agreement. You pay your daughter $12,000 at once for the last year of help. Without a signed contract and time logs, that's a lump sum gift. Clean approach. Sign a care agreement now. Start paying going forward at market rates. And if your state allows limited retroactive pay, support it with detailed logs and proof. Many states won't accept back pay at all. Confirm locally. Eighth, prepaying funerals with revocable plans. Revocable equals countable. Use an irrevocable pre-need contract within state limits, itemized with the funeral home's documentation, and a receipt that matches your bank statement. Burial spaces are typically exempt. Record the purchase. Ninth, DIY annuities and financial products. Buying an annuity that isn't Medicaid compliant turns cash into a still countable asset and can lock up funds you need. The contract must meet specific terms. Immediate, non-assignable, actuarially sound equal payments, and the state named as remainder beneficiary up to benefits paid. Anything else wastes time and money. 10th, title changes. Without understanding consequences. Adding a child to your deed or bank account inside 5 years can create a transfer. Some deed types avoid probate, but don't avoid the lookback or estate recovery. Before you change titles, check your state's treatment and document the purpose. Microstory, the $5,000 car sale. A son bought mom's 10-year-old sedan for $5,000. Blue Book in fair condition said $9,200. No mechanic report, no photos of damage. Medicaid counted $4,200 as a gift and added nearly half a month to the penalty. We salvaged it by getting a late mechanic assessment and repair estimates that showed transmission issues, pulling the fair value down to about $5,800. The gift shrank to $800 and the penalty dropped. Paperwork made the difference. 2 more quiet landmines. Charitable giving beyond a long-established pattern. If you've tied $100 monthly for years, staying consistent is defensible. Suddenly writing $5,000 checks in the year before application raises flags. And credit card points games, buying gift cards or making odd purchases that look like pass-throughs. Invite questions unless receipts clearly show legitimate household spending. How do you avoid these traps in real life? Use 3 habits. First, write first, pay second. Draft care agreements, promissory notes, and purchase estimates before money moves. Second, document market value every time. Appraisals, comps, repair estimates, invoices. Third, keep a running transaction log for 5 years. Date, who, what, why evidence. If you can hand a caseworker a binder that tells a clean story approvals move faster, and penalties shrink. Simple habits beat expensive mistakes. If you remember nothing else, gifts, bargains, cash, and guesswork create penalties. Contracts, fair value, and receipts prevent them. Move like a bookkeeper, not a gift giver. Documentation, the caseworker actually accepts. Everything we've talked about lives or dies by your paperwork. Caseworkers aren't out to trick you. They're trained to verify. If you hand them clean, complete documentation, approvals move. If you hand them gaps and guesses, penalties grow. So let me show you exactly what they accept and how to build it now. Start with bank evidence. You'll need 5 years of statements for every account with your name on it. Checking, savings, money market, CDs, brokerage cash sweeps. Canceled checks or check images matter for large or unusual transactions. Keep deposit slips and screenshots of mobile deposits. For electronic transfers, Zelle, Venmo, ACH. Print the transaction details that show sender, recipient date, and memo. If a transfer involved a family member, add a written explanation and any matching invoice or receipt. Assume every unexplained dollar will be questioned. Next, proof of purchases. Caseworkers want itemized receipts and invoices tied to the bank or card transactions that paid them. If you bought medical devices, attach prescriptions or doctor recommendations when available. For home repairs, include contractor estimates, final invoices, proof of payment, and photos if the work helped with safety or accessibility. Link each receipt to the exact payment line on the statement with a simple note like matches 3/12 chase, $1,486. Property documentation is non-negotiable. If you sold real estate in the last 60 months, include the deed, listing agreement, settlement statement, appraisal or market comps, repair estimates that justify price adjustments, and proof of where proceeds went. If you still own the home, include the deed, latest property tax bill, mortgage statement, and if there's a spouse or qualifying relative living there, a brief statement confirming occupancy and relationship. Vehicles need a title copy, blue book valuation printout at the time of sale, mechanic reports if condition affected value, the bill of sale, and proof of payment received. If you replaced your primary vehicle as a spend down, show the purchase contract, lien details if financed, and trade-in documents that establish fair value. Insurance and annuities require the actual contracts, not just summaries. Provide policy declarations for life insurance, the cash value statement, and any surrender paperwork. For annuities, include the full contract, riders, annuitization schedule, payout start date. Ownership, beneficiary designation showing the state listed appropriately when required, and evidence that it's non-assignable and actuarially sound. If you drew distributions, include 1,099s to match income entries. Caregiver payments live or die by the paper trail. A valid personal care contract is signed and dated before services, spells out duties, hours, rate, start date, and termination terms. Add weekly timesheets signed by both parties and proof of payment, checks with memo lines or bank transfers with notes like care hours 5/1, 5/7. If an agency provided care, attach agency invoices and paid receipts. Avoid lump sums. Think payroll rhythm. Loans must look like loans. Include a signed promissory note from the date of the loan, interest rate at or near market, repayment schedule, and proof of repayments hitting your account. A loan with no payments reads as a gift. If a borrower repaid in cash, that's weak. Ask for replacement repayments by check or transfer, and write a statement explaining the correction. Charitable giving needs consistency. If you tithed or donated regularly, show a multi-year pattern with annual statements from the organization. If there was a one-time large gift, add a letter from the charity acknowledging the donation and your explanation, but expect scrutiny. Consistent amounts are easiest to defend. Build a transaction log. Open a spreadsheet with columns: date, amount, payee or recipient, purpose, evidence on file, notes. Every unusual or large transaction gets an entry. Link the log line to the matching statement page number and receipt file name. When the state asks, you won't scramble, you'll print the line, the statement, and the receipt together. This is your viral level hack. One sheet that answers 90% of questions. Create a Medicaid binder. Sections: cover sheet with applicant info, contacts list for attorney, facility, caseworker, identity documents, income sources with award letters, and 1099s, assets with statements and policy contracts, transfers with the transaction log and evidence, property records, caregiver agreements and timesheets, medical necessity evidence like physician assessments or level of care forms. Use dividers and label everything. Write clear explanations. For anything unusual, a one-paragraph letter helps. Who, what, when, why, and which documents prove it. Keep it simple and factual. On July 18th, withdrew $900 cash to pay plumber for emergency leak. See plumber invoice dated July 18th and receipt marked paid. Matches 7/19 bank withdrawal. Quick when you can do today. Start the master spreadsheet and request electronic statements for the last 60 months from every bank and brokerage. While you wait, gather policy contracts, deeds, titles, and funeral pre-need documents. The faster you assemble, the less you private pay. If you remember nothing else here, documentation wins. Itemized receipts tied to statements, contracts signed before money moves, valuations for anything sold, and a clean log turn questions into approvals. Real scenarios, how families navigate the trap. Let's make this real, with 4 common situations and the exact moves that work. Scenario 1, single applicant who gifted $20,000 3 years ago. Mom wrote 5 $4,000 checks to grandkids for tuition. Today she needs nursing home care. In her state, the penalty divisor is $8,500. $20,000 divided by $8,500 is about 2.35 months of penalty. The nursing home still expects payment during that window. What can you do? First, reconstruct documentation. If any of that gift actually paid the school, directly get bursar statements and cancel checks from mom to the school. Direct payment for the student's bill can sometimes be treated as mom's expense, not a gift if the documentation ties her as payer of record. If the money went to grandkids, you can ask for partial repayments. Returned funds shorten the penalty when repaid before the eligibility month. Next, reduce private pay time by spending down remaining countable assets on exempt needs now. Irrevocable burial, dental work, hearing aids, home safety for a potential discharge attempt. And file the application so the penalty clock starts. Coordinate with the facility business office to plan bridging payments for the penalty months and prevent discharge risk. Scenario 2, married couple in crisis. Dad needs nursing home care. Mom is healthy at home. They have $210,000 in countable assets combined and $3,200 in monthly income split between them. The state's community spouse resource allowance allows mom to keep, say, $154,000. Strategy: move all liquid accounts into mom's name. Then spend down the excess, about $56,000, on clean items. Home repairs, a reliable primary car, prepaid irrevocable burial for both, and outstanding medical needs. If the spend down still leaves excess, and the state allows it, convert it into a Medicaid-compliant annuity payable to mom with level payments, actuarially sound terms, non-assignable language, and the state as remainder beneficiary. File the application once assets are at or below the allowed levels, and make sure mom claims the minimum monthly maintenance needs allowance so she keeps enough of the couple's income. The result: Dad qualifies without gifting, mom keeps protected resources and sufficient income, and the home stays exempt while she lives there. Scenario 3. Adult child caregiver, signed contract versus verbal promise. Two brothers helped mom for 2 years. Family A had a written personal care agreement from day one. Duties, hourly rate tied to local market, weekly timesheets, and payments by check with memos. When they applied, those payments were accepted as legitimate expenses. No penalty. Family B did the same care but no contract, and then took a $24,000 lump sum reimbursement right before filing. Medicaid labeled it a gift, added a penalty, and slowed approval. The fix for Family B was limited. They created a forward-looking care contract, stopped lump sums, and built weekly logs. Some states allow a modest retroactive correction if you can produce detailed, contemporaneous logs. Many don't. The lesson is simple: paperwork before pay and pay on a schedule. Scenario 4. House equity and estate recovery. Life estate versus doing nothing. Mom owns a home outright. She qualifies for Medicaid. The home is exempt during her life. The kids ask, can we avoid estate recovery? Options depend on state law. A properly executed life estate or ladybird deed, done well before crisis and consistent with state rules, can pass the home outside probate and limit recovery. But if you transfer a remainder interest inside 5 years, that's a disqualifying transfer. If you're already in crisis, you don't move the title. Instead, you preserve the exemption while mom receives care, document that a community spouse or a disabled child lives there if applicable, and plan for hardship waivers or recovery negotiations later. If you're outside 5 years, work with an elder law attorney to evaluate deed options that meet state requirements and don't block flexibility. Quick wins for each type. Single with past gifts. List every transfer, chase receipts, and ask recipients for partial returns now. Start the penalty clock by filing as soon as you're otherwise eligible. Married in crisis. Lock down the community spouse allowances, gather current statements, execute permitted transfers, and pre-approve any Medicaid-compliant annuity with counsel before purchase. Caregiver family. Sign a care contract today. Set a market rate, track hours, and pay weekly. Stop all back pay lumps. Home and recovery. Confirm how your state defines estate, whether enhanced life estates are recognized, and keep taxes, insurance, and occupancy documented. 2 final pointers. First, coordinate with the nursing home business office. They know the divisor, processing timelines, and what documentation moves cases faster. Second, keep communication tight among siblings. One unauthorized gift or account shuffle can reset the clock or create a penalty everyone shares. Align on the plan. Assign roles: paperwork lead, facility liaison, legal contact, and update your Medicaid binder weekly until approval lands. Small team habits prevent big dollar mistakes. Caregiver coordination without breaking eligibility. Caregiving gets messy fast when the money piece isn't organized. The goal is simple: support the caregiver, keep the applicant safe, and avoid moves that look like gifts. Let's make that happen with clean systems you can set up this week. Start with paying family legally. Use a written personal care agreement signed before services. It should name the caregiver, the tasks they'll do: bathing, meals, meds reminders, transportation, hours per week, start date, hourly rate tied to local market, and how payment happens. Keep it simple but complete. Attach a W-9 from the caregiver so you can issue a 1099 if required. Some families run payroll. Others use a home care payroll service. Either way, money moves on a schedule, not in random lump sums. Track hours and services like a time clock. Weekly timesheets, signed by the caregiver and the care recipient or power of attorney, are your backbone. Use a free template or a basic app. Log start and end times, tasks performed, and any mileage with purpose. Pay by check or bank transfer with clear memos. Care 6/3, 6/9, 18 hours at $22. That paper trail converts money to family into documented care at fair value. Don't skip this. After the fact payments, especially big ones, are magnets for penalties. Use respite and adult day strategically. Caregivers burn out, and burnout leads to rushed financial decisions. Adult day health can give 8 hours of supervision at a lower cost than one-on-one care. Some states' waiver programs cover part of this. Pair adult day with family care in the evenings, and you can reduce the total cash burn while keeping structure. Track every invoice and payment. It shows a consistent care plan rather than sporadic spending. Now, sibling communication. Money friction often starts with the phrase, "I thought." Fix it with a lightweight protocol. Hold a 30-minute monthly call. One person is the paperwork lead. One is the facility or agency liaison. One is the medical appointment lead. Share the Medicaid binder index in a shared drive and grant view-only access to bank PDFs. Any gift, transfer, or unusual purchase requires group text approval first. That one rule prevents a well-meaning sibling from handing out gas money that becomes a disqualifying gift. Align the care plan, finances, and the application timeline. If you're aiming for a Medicaid application in 60 days, backplan the steps. Week 1, finalize the care contract, start timesheets, and pause all gifts. Week 2, request 5 years of statements from every bank. Week 3, get appraisals or blue book printouts for any recent family sales. Week 4, schedule medical and dental work you'll use for spend down. Week 5, execute clean purchases, irrevocable burial, safety modifications, durable medical equipment, with receipts ready. Week 6, run your penalty estimate, meet with the facility business office, and file. Coordinate with providers to avoid accidental disqualifiers. Tell the home care agency you're documenting for Medicaid and need itemized invoices with dates, hours, and caregiver names. Ask the primary care office for a level of care assessment letter to support medical eligibility. If a therapist or nurse recommends equipment, get it in writing to attach to the receipt. Those notes transform purchases from nice to have into medically necessary spend downs. Handle reimbursements the right way. If a sibling buys supplies or pays a bill, reimburse quickly with an itemized receipt and a memo on the check that matches the receipt date and item. Avoid cash paybacks. Build a shared expense form. Date, item, purpose, amount, receipt link. Medicaid reviewers love clean alignment between receipts and bank statements. They get suspicious of vague cash. Watch for caregiver tax and benefits issues. Paid family caregivers are usually independent contractors unless you run payroll. Confirm with a tax pro. Avoid room and board offsets unless your state allows and your contract spells it out. If the care recipient is on SNAP or housing assistance, sudden shifts in household contributions can ripple. Check first. Plan coverage during a penalty period if one exists. If your estimate shows, say, a 1.8-month penalty, set aside the funds to bridge that window or negotiate with the facility for a short agreement. Keep caregiver hours steady and document every payment. The aim is to glide through the gap without frantic moves. Finally, keep morale up with structure. Caregiving is emotional, systems lower stress. Weekly pay, weekly logs, monthly check-ins, and a visible countdown to application milestones make the process predictable. When something unusual happens, an ER visit, a broken appliance, pause, write a one-paragraph note, attach receipts, and move on. That habit keeps you eligible and sane. Applying for Medicaid without panic. Let's turn your prep into a clean application. The goal is simple. File fast, disclose accurately, and respond on time so you minimize private pay days. Start with a pre-application checklist. You need identity documents, photo ID, social security card, Medicare card, birth certificate if available. Income proofs, social security and pension award letters, annuity statements, recent 1099s, and 3 months of pay stubs if any. Assets, the last 60 months of bank statements for every account with the applicant's name, current balances, brokerage statements, CDs, life insurance cash value statements, and full annuity contracts. Property, deed, latest tax bill, mortgage statement, homeowner's insurance. Vehicles, titles, and current Blue Book printouts. Transfers, your transaction log, receipts, appraisals, caregiver contracts, and notes explaining anything unusual. Before you touch the forms, reconcile your numbers. Total countable assets against your state limit. Confirm you've completed clean spend downs and moved any spousal assets per the plan. Double check that caregiver payments match contracts and timesheets. If something's still fuzzy, fix it now. Once you file, you're on a clock. Completing the application comes down to precision. Answer every question. Don't leave blanks. If it asks for account numbers and balances, list all accounts, even dormant ones. For transfers, disclose them upfront with your transaction log attached. You're not trying to hide. You're controlling the narrative with evidence. Where the form has limited space, write "See attached transfer log" and include a neatly labeled packet. How specific should you be? Vary. If you sold a car, list the date, buyer, price, and attach the bill of sale, Blue Book page, and deposit proof. If you prepaid burial, include the irrevocable contract and the matching bank statement line. If you reimbursed a sibling for supplies, attach the receipt and a canceled check with the memo matching the receipt. The more you tie documents to statement lines, the fewer back and forth letters you'll get. Timing matters. File when you're financially at or below the limit, medically eligible, and ready to survive requests for more docs. Don't wait for perfection. Aim for complete enough to start review. If a penalty is inevitable, filing now starts the penalty clock once you meet the criteria, which shortens private pay time on the back end. Speed reduces cost. Precision prevents denial. Expect an information request within a few weeks. The letter will list specific items and a deadline. Meet it early. If you can't, call the caseworker the same day you receive the letter, verify receipt, and ask for a short extension while you gather a missing item. Then send partials as you get them rather than holding everything for the last piece. Always label, applicant name, case number, and a contents list on top. How do you send documents? Use the channel your state processes fastest, often a secure upload portal or in-person drop-off stamped, received. Avoid faxing unless that's the only option. If you do, keep confirmation pages. Scan to PDF, combine related items, and name files clearly. bank_abc_checking_2019-2024 statements.pdf, transfer_log_with_receipts.pdf. Sloppy file names cause internal delays. If denied, don't panic. Read the denial reason carefully. Many denials are fixable, missing statements for a specific month, an unexplained transfer that you can document, or a misunderstood asset classification. Respond with exactly what they asked for plus a short cover letter pointing to the evidence by page number. If the issue is a true transfer penalty, rerun your math, see what can be reclassified with better documentation, and ask recipients to return funds, if possible to shorten the penalty before the eligibility month. Serious red flags are different. Intentional concealment of accounts, false statements, or large, recent gifts without any path to curing. If that's the situation, pause and get an elder law attorney involved immediately. You may still recover eligibility, but you need strategy. Appeal basics are straightforward. States set strict timelines, often 30 to 90 days from the notice. File the appeal to preserve rights. Then continue supplying documents. Ask for an informal conference first. Many issues die there once a supervisor sees your binder. If you need a hearing, prepare a simple packet, timeline, transfer log with evidence tabs, and a one-page summary of why your transactions meet fair value or are exempt. Microstory. A family got denied for undocumented $2,400 transfer. They paid a plumber in cash during a flood. We called the plumber, got a duplicate invoice marked paid, matched the date to the bank withdrawal, added a photo of the repaired wall, and wrote a 3-sentence explanation. Resubmitted within the window. Approval came through the next week because the paper trail now told a clean story. 2 final moves to keep momentum. First, stay in weekly contact with the facility business office. Share updates, get their help interpreting requests, and coordinate any short-term payment plan if a brief penalty applies. Second, maintain your binder and spreadsheet throughout review. Every new request gets logged with requested date, sent date, and what page. That discipline halves your review time. If you remember nothing else, file clean, disclose fully, respond fast, and keep the narrative evidence-based. The more your paperwork answers questions before they're asked, the faster you move from panic to approval. Estate recovery, the second trap after approval. You breathed a sigh of relief after approval. Now, you need to guard the estate. Medicaid estate recovery is the program that lets the state recoup the cost of long-term care from the recipient's estate after death. During life, many assets can be exempt. After death, the state looks for repayment, especially from the home if it passes through probate. If you don't plan, the house is often the target. Here's the thing most people miss. Estate is defined by state law. Some states only recover from the probate estate, assets that pass through the will. Other states use an expanded definition that can reach certain non-probate transfers, like some life estates or payable on death arrangements, depending on the details. That means a deed or beneficiary setup that avoids probate might still be exposed in some places. You have to check how your state defines estate in recovery, not just in probate. When is recovery delayed or blocked? If there's a surviving spouse, recovery generally waits until the spouse dies. If there's a child under 21 or a blind or permanently disabled child, recovery is typically prohibited while that status exists. States must also offer hardship waivers. A common example is when the estate includes a modest home that's the primary residence of a low-income heir who's lived there for a qualifying period, or when the estate asset is a family business or farm that supports the survivor's livelihood. The waiver standards and proofs are state-specific and deadlines matter, so you prepare early. Now, the home. While you're alive, the home can be exempt for eligibility. After death, unless a protected survivor blocks it or a waiver applies, the state can claim against the estate up to the amount Medicaid paid. That doesn't mean agents show up with locks. It means a claim gets filed in probate. If the home has to be sold, the claim gets paid before heirs. If you avoid probate with the right deed or trust, recovery might be limited or avoided in some states. Again, only if your state's recovery laws don't reach that transfer type. Let's talk tools and timing. If you're outside the 5-year window and your state recognizes them, a properly drafted life estate or an enhanced life estate, Ladybird, deed can move the remainder interest to heirs while you retain the right to live in the home. Because the transfer happens at signing, it's a gift for look-back purposes. Done more than 5 years before applying, it can pass the property outside probate and may limit recovery. Done inside 5 years, it's a disqualifying transfer that creates a penalty, so timing is everything. Revocable living trusts avoid probate, but usually don't avoid Medicaid counting or estate recovery. Why? You still control the asset. Many states can recover against assets in a revocable trust. Irrevocable trusts are different, but only if you surrendered control and beneficial use, and only if the transfer is outside the lookback. Even then, some states' expanded recovery rules can complicate outcomes. This is why you don't copy a neighbor's deed or trust. One paragraph can flip the result. Hardship waivers need evidence. If an adult child lived in the home and provided care that delayed institutionalization for at least 2 years, some states have a caregiver child exemption for transfers during life, and others consider that history favorably in waiver decisions after death. You'll need proof, residency, caregiving logs, medical notes showing delayed placement. If the heir is low income and would become homeless, gather income proofs, tax returns, utility bills, and any state forms quickly. Waiver windows are short. Start assembling before you need it. 2 moves that help families avoid surprises. First, understand lien versus recovery. States can place liens in some circumstances during life, but they don't force a sale if a spouse or qualifying relative lives there. After death, the claim usually appears in probate. Knowing the difference helps you respond calmly and meet deadlines. Second, keep the home shipshape, taxes current, insurance paid, and occupancy documented. If a hardship waiver depends on continuous residence, don't let a paper gap undermine it. Micro story. A son lived with mom for 4 years, reduced work hours to provide daily care, and kept a simple notebook of tasks. After mom's death, the state filed an estate recovery claim for $118,000. We submitted a hardship waiver packet, proof of his residency with tax returns and driver's license, caregiving notes, letters from mom's doctor that his care delayed nursing home placement, and evidence of his income. The waiver was granted. The state released the claim. The difference wasn't a fancy strategy. It was complete documentation. Action steps to start now. Confirm your state's definition of estate for recovery. If a spouse or qualifying child lives in the home, document occupancy with utility bills and IDs. If you're outside 5 years and considering a deed change, meet an elder law attorney to evaluate a life estate or ladybird deed that fits state law. If you're already on Medicaid, don't retitle the home casually. Focus on preserving the exemption and preparing a hardship plan if needed. If you remember nothing else, eligibility protects care now. Recovery looks for repayment later. The home is exempt during life, but exposed at death unless a survivor blocks recovery, a waiver applies, or your state's rules and your prior planning place it outside reach. Plan the exit while you plan the entry. Your action plan: 10 steps to stay safe. Here's the clean, do this next plan that pulls everything together. Inventory everything. List bank accounts, investments, retirement accounts, life insurance with cash value, property, vehicles, personal items. Note ownership, balances, and whether you can liquidate. You're building the baseline so you know what has to be reduced or restructured. Sort assets into 3 buckets: exempt, countable, risky. Exempt might include the primary residence subject to equity limits, 1 vehicle, personal items, irrevocable burial, and depending on state treatment, certain retirement accounts in payout. Countable is cash, non-retirement investments, extra vehicles, second properties, non-compliant annuities, and cash value life insurance above limits. Risky includes joint accounts with kids, informal loans, and any asset with unclear ownership. Pull the last 60 months of statements for every account with the applicant's name. Ask banks for full PDFs with checked images. Download brokerage activity, retirement distributions, and credit card statements if you used cards for big purchases. Create a folder per account and name files clearly. Build your transfer log. In a simple spreadsheet, record date, amount, payee or recipient, purpose, and evidence on file for every non-routine transaction. Link each entry to the exact statement page and receipt file name. Add brief notes where context helps, like roof leak, see photo and invoice. Freeze gifts, and stop bargain sales. From today forward, no transfers for less than fair market value, no reimbursements without itemized receipts, and no title changes. You're preventing new penalties and letting old ones age off the clock. Execute clean spend downs. Use Countable dollars for legitimate needs. Irrevocable funeral/burial, dental and vision care, hearing aids, durable medical equipment, home safety upgrades, and a reliable primary vehicle if needed. Collect estimates first, then pay by check or card, and file receipts with matching statement lines. Pay family caregivers the right way. If family helps, sign a personal care agreement that lists duties, hours, start date, rate tied to local market, and termination terms. Start weekly timesheets and pay on a regular schedule with memos like Care 7/1, July 7th. No lump sum back pay without airtight logs, and confirm whether your state allows any retroactive payments at all. Optimize spousal protections if married. Move countable assets to the community spouse, up to the community spouse resource allowance, then plan a spend down of any excess. If your state allows Medicaid compliant annuities for the community spouse, have an experienced attorney pre-approve contract terms before purchase. Make sure the community spouse's income reaches the minimum monthly maintenance needs allowance. Pre-file readiness check. Recalculate countable assets. Confirm spend down receipts. Care contracts, appraisals, and any annuity or insurance papers are complete. Estimate your state's penalty divisor with help from the facility or a local elder law office and run your penalty math. If a short penalty is likely, coordinate a bridging plan with the nursing home business office so care continues smoothly. File clean and respond fast. Submit the application with your organized binder. Identity, income, assets, property, transfers, contracts, and a cover sheet listing what's inside. Expect an information request. Reply early with labeled PDFs. Log every request and response date. If denied for fixable reasons, correct and resubmit within the window. If you hit a serious issue, bring in counsel and pursue an appeal promptly. 2 bonus habits keep you safe. First, monthly Medicaid huddles with family, status updates, documents gathered, and upcoming purchases. Second, a living checklist, what's left to request, who's assigned, and the due dates. That keeps momentum and reduces private pay days. Quick wins you can tackle today. Request 60 months of statements, start the transfer log, schedule quotes for burial and home safety, and draft a 1-page care agreement if family is helping. By the end of the week, you'll have the skeleton of your binder and a clear spend down list. One more reminder about estate recovery while you plan: keep home taxes and insurance current, document who lives there, and ask an elder law attorney about your state's estate definition and any deed options, but only if you're safely outside the lookback. Inside 5 years, focus on eligibility now and a hardship plan later. Don't trade today's approval for tomorrow's recovery surprise. This plan isn't flashy. It's methodical, documented, and fast to execute. That's exactly why it works, and why families who follow it avoid the 5-figure traps most people stumble into. The core skill you learned is simple. Stop gifts, document everything, convert Countable to Exempt at fair value, and let clean paperwork carry you through approval. Start your Medicaid binder tonight. Request 5 years of statements, build your transfer log, and price out clean spend downs. Then watch my deep dive on spend down strategies for exact examples you can copy. Subscribe for weekly senior money safeguards so you never get blindsided again. And share this with the one sibling who needs to see it most.